Hi, this is Brian Zeek, founder of SurfSea Financial Group. In this webinar today, we're going to actually take you through and show you the 3 little-known secrets for creating a secure financial future without taking on any additional risk. We have a lot to cover here, so why don't we go ahead and get started? Because in this training, you're going to discover, number 1, the 4 most important financial questions everyone, if you're serious about your financial future, you need to know. Number 2, how to increase your rate of return on investment without increasing your risk. And finally, how do you rate your financial alternatives? Select the perfect savings vehicles for you. Okay, first we're going to cover those 4 most important financial questions. What rate of return do you have to earn on your saving investments dollars to be able to retire at your current standard of living and have your money last through your life expectancy? How much do you need to save on a monthly or annual basis to be able to retire at your current standard of living? Again, have your money last till life expectancy. Doing what you're currently doing, how long will you have to work to be able to retire and live your current lifestyle till the end of your life? And if you don't do anything different than you're doing today, how much will you have to reduce your standard of living at retirement for your money to last to your life expectancy? Now let's walk you through a case study here. Mary and John, age 56 and 57, and they're about 10 years away from retirement. They currently enjoy an income about $202,000 combined. Mary is projected to receive about $2,733 a month in Social Security at full retirement, and John $2,450 a month at full retirement. Now they're currently saving about $15,000 a year, annual savings. They have about $556,000 in 401k money. They have another $39,000 in IRA money. And they have a mutual fund account about $105,000. Now they're currently saying they were receiving about 7% rate of return. They plan on being a little more conservative in retirement and earning about 5%. So let's take a look at the results of that case study. So we're seeing that based on the numbers we just showed you, a 7% rate of return, and so on and so forth. They want to retire at age 66. When they reach full retirement ages, based on those projections, they would have had $1.6 million. Unfortunately, you're noticing that they ran out of money at age 74. So their retirement funds didn't even last them 10 years, which is probably not what they had in mind. So let me take you through and show you how we actually calculate those numbers. So you're seeing here John and Mary, age 56, retirement age 66. They have a life expectancy which is fairly normal for couples at age 90. Their income, they've accumulated between those 3 accounts, they've accumulated about $700,000. That's 17 accumulation retirement. Now we have a projected inflation rate of about 3%, which is kind of normal. And a tax rate of about 30% combined. Defined benefits, they have the Social Security, which is in here. And we see the retirement lifestyle in today's dollars would be $130,900. Now we are applying a COLA to that. Now let's take a look. Now basically here's that same numbers, but here we actually, and this is where we calculated, here we can actually show if we made changes, right? So we're seeing that rate of return now again. And what you're looking at here is the present projections. And once we make our adjustments up here, you're going to see the revised. So let's calculate out the return they would need to actually make it to age 90. Wow, they would actually have to get a 17.5% rate of return between now and when they retire these next 10 years. About 70%, which is, I'm going to say, pretty unrealistic and pretty risky. But you will see on this projected side, they did make it. And you see here, this is their Social Security still left. This is what they'd have left at age 90, but they did make it. Although, again, pretty high risk there. Okay, now they could plan on saving more. Now, what would they need to save to make it to 90? They would actually have to save $153,000 for the next 10 years. Now, if you remember what they were actually living on, kind of not going to work because that's more than actually living on now. So that would probably be a no-go. Now, suppose they can get a couple extra part-time jobs and maybe do that, but probably not what they had in mind. Now, they could work longer. Now, depending on what you do, that could be doable, but probably not appetizing, because they would actually have to work to age 76, a full 10 additional years. Again, not probably not what they had in mind. And finally, they could spend less money. In other words, reduce their lifestyle. So here we reduce their lifestyle. So we see basically the same amount of money, just reduction in lifestyle, seeing here from 175 down to 95. So they actually reduced their lifestyle almost in half. But again, you see here that they actually, they did make it to life expectancy. Now again, probably not what they had in mind. Now we have ways of fixing these problems. That's what we do. That's what we're at Surf Financial Group. How we approach these things. So let's take a look at how can we increase your rate of return, because the average American family saves about 4 cents on every dollar earned and spends the other 96 cents. So most financial advisors focus on providing investment strategies for only the 4 cents. We actually put out a book and we talk about this a lot because we feel there's a big difference between an investment person and an actual advisor, but conversation for another day. But at Surf Financial Group, we do take a different approach. We analyze the entire dollar and look and specialize in finding areas of your spending that are creating wealth transfers that you may not even be aware of. Let's look at some math here. Let's assume you earn $100,000 a year and you're saving about 4% of your money. And let's say you're making about 5% rate of return on your savings. That equals about $200 in investment return. In other words, you've earned about $200 on that 4%. Now, if we can help you find just 2% on your earnings, in other words, 2% that you weren't saving before in hidden wealth transfers, that would save you an additional $2,000 more a year. That would increase your rate of return on your existing savings from 5% to 55% without taking any additional risk. Now, how do we do that? Sorry about that. Where are the hidden wealth transfers? Taxes on compounding returns in taxable accounts. That's one we always look at. In other words, maybe that mutual fund account. Term insurance premiums. You know, the old buy term invest, so the difference. We'll definitely go into that. Interest on credit cards, auto loans, and leases. Declining tax deductions on prepaying mortgage principal. And future tax liabilities on earnings from contributed contributions to qualified plans. It's one thing we always say about qualified plans. You have a partner in that deal. And that's called the federal government. Part of that, those savings do belong to the federal government. Now let's take you through this. All right. Now here is all the different wealth transfers that we look at. This is some of the things we talked about, education and so on and so forth. And these are where we find those wealth transfers. Now let's first take a look at homeowners insurance. Now we know with homeowners insurance, you have choices, right? Let's say the value of your house is $500,000, and let's say you have a choice of deductible between $250 and $1,000. And now we say on one your annual premium is $2,000, on the other your annual premium is $1,000. In other words, you take a little more risk by raising that deductible. Opportunity costs, say you're getting that 7% rate of return on your investments. Now, if you calculate that out, that's 0.40% of your premium, and this is 0.20. Now, at age 56 to 67, let's say what that would look like. The difference in your premium is $1,000. So the opportunity cost difference premium is $16,888. So in other words, if you were to take that the difference in those premiums and put it away, you would actually earn $16,000 based off the return. So the future value of the difference premium $1,000 compounded up to rate 7% for 11 years. So total premiums paid in that scenario $22,000. Total premium return is $11,000. So you're taking a difference and you're earning 7%. So that's basically how that works. Now let's also look at credit cards, because that's one surprisingly I run into quite often. So say you're carrying a $10,000 credit card balance, and the interest on those are about 18%, and investment rate of return of 7%. So let's say you're carrying that credit card debt for 5 years, which again, not uncommon. The amount of interest you would pay would be $9,858 over that 5 years. Over 20 years, you see, it gets to be real money. Potential, had you been able to invest that difference, would have been $11,000. Almost, over that. The lender would have made almost $15,000. So that is a major wealth transfer we look at all the time. So those are a couple examples of where some of the things we look at. But again, that's why when we say we look at every dollar, we're pretty serious about that. And again, these are some examples. Okay, now let's start going into how do we rate your financial alternatives. Select the perfect savings vehicle for you. Now, what are the benefits of the savings account that we want? What are we looking for in a savings account? Number one, we typically like deferred growth. I mean, who doesn't? You want your money to grow without paying taxes on it, because we talk a lot about taxable accounts and that you get taxed along the way. So we don't actually see the cost of that account, because we're usually paying out of lifestyle. Tax-free distribution. Yeah, I think we all like the idea of getting our money tax-free. That would be done through, different vehicles. Competitive return. Of course, we want a competitive return. We all like the rate of return as high as we can get. High contributions. In other words, if you find that perfect financial vehicle, wouldn't you like to put as much as possible in it? Any additional benefits? Let's say you can get coverage to say you got hurt and your contributions were able to continue. Things like that. Collateral opportunities. Once you have this account built, once you have some money in it, wouldn't it be nice if you didn't have to touch your money and you can actually collateralize it? In other words, borrow against it. You take it to a financial institution and say, hey, I got this. Can I, just like you would your house, right? If you want to do an equity line and get to that money, you can actually say, hey, I got all this equity. Can you loan me money against the equity? That would be a collateral opportunity. Safe harbor. All right, let's say we get sued. Don't we like the idea of that money being protected? A no loss provision. In other words, what if we had an account that didn't go backwards? In other words, if the market's dropped, we didn't lose any money in it. Guarantee loan options. That kind of goes back to collateral opportunity. What if we had this money, because we know, like, for instance, a home mortgage or an equity line is not guaranteed. You have to go ask permission for it. What if we had an account that actually had a guaranteed loan options? Unstructured loan payments. Well, let's say we borrowed. We're able to get that loan, right? And we didn't want to pay it back at a certain pace. What if something came up and we didn't want to make that loan payment for a while or at all? Wouldn't that be a nice option to have? Be able to control how you paid or if you paid that back. Liquidity using control. In other words, can I get to that money? If I really need to get that money, can I get to that money? Can I borrow against it? Well, do I have actually access to that money? Wouldn't it be nice if we can deduct the contributions of that money? Yeah, we all like that idea. In other words, none of us like paying taxes. I have not met anyone yet that enjoys paying their taxes, even though we know it's important. Well, there's I think the perfect savings vehicle if we can have all those things. Well, let's take a look at what is the most highly used savings vehicle out there, and that's qualified plans. So what do we get with qualified plans when we're looking at those benefits? Of the 12 benefits we're looking for, what does a qualified plan actually offer us? With like a 401k. We get tax deferred growth, no doubt. We do get typically a competitive return unless we happen to get a downturn in the market. It is a 401k is a safe harbor. It is protected from lawsuits. And you have deductible contributions. Now, and one other I could have added there is typically in a lot of 401ks a loan option, but there's problems with that loan option too. So we can talk a little bit about that. It does impede certain things, and there's very much limitations on that. We're not a big fan of those, but it is there in some 401ks. Now let's recap what we covered. We went over the 4 most important financial questions. Everyone, again, we think you should know this because you can't fix what you don't know. How to increase your rate of return on investments. Well, we showed you that. In other words, you look at every dollar you have, not just the invested dollars. And if we can bring those dollars back into your savings vehicle, especially if you find that preferred savings vehicle, wouldn't you like to, that money you find that you're giving away unnecessarily and knowingly, wouldn't it be nice if you didn't have limitations on how much you can put back into that vehicle? So there's the 3 important questions you should be asking and things and strategies you should be employing. Now we can show you this, and we teach this through our Financial Accelerator. And it's a 6-week online financial education program for creating a secure retirement. We will go into all those things. And how we do that is we take it through our 6-step system for creating financial security. We connect, we analyze, we optimize, we design, we implement, and then we're big believers in reviewing on at least an annual basis, seeing where we're at. We work with our clients on that on a regular basis. And here's what you'll get. 6 on-demand core modules. These modules are delivered inside the private members area. Financial implementation checklist. This checklist outlines your homework items in each week of the program. And a one-on-one coaching session. So there's along the way we will have one-on-one coaching sessions. These are virtual or in-person meetings, and will help us get to know your goals and educate you on various these different financial strategies. You'll get a retirement ready or not report. Basically, a report we just showed you that answers the 4 most important financial questions that we showed you a bit of an example of. And a customized financial illustration and wealth report. Plus these bonuses, we'll also throw in these Circuit financial organizers. In other words, we put all your financial information. A monthly budget tracker. This will help you analyze your current spending habits and identify possible places where you could actually reduce expenses. A client communication profile. This is a 10-minute online assessment we offer everyone we're working with. You and your partner will take so you can learn how to better communicate with one another when it comes to your finances. Because everybody's wired differently. We need to know how to communicate these, because I need to know how to communicate with you and your partner as well. And our Surf City Wealth Strategy video library. This video library on various financial topics, including your money flows, mortgages, qualified plans, and so on and so forth. We have lots of different videos, and we're always creating more. Plus these bonuses, wealth building guides, learn the top 5 wealth building strategies and more, tax resources, the tax calendar lists important dates of federal tax calendar, tax forms, full set of downloadable forms from the IRS, tax publication, full set of downloadable publication IRS, tax rates, tables to enable you to find your federal marginal income tax rate. Total value about $4,000 on all this stuff. I mean, it's a lot of information that we've put together for you. Now, how do you get there? How do you get all this? How do you get access to this? All we need to do is apply now for your free scholarship. We do sort of limit this because we can only work with so many people at a given time. And all you have to do is go to surfcityfinancialaccelerator.com and apply for that free scholarship. Basically, you can go in there, you fill a form or give us a call and kind of look around and feel free to apply. We absolutely look forward to working with you on this and seeing if we can solve any problems you might have. Number one, we can figure out where you're at. And even if you're in pretty good shape, this is just make you better. There's a lot of good information in there that's going to help you understand money, how money flows, how money works, and different financial vehicles and how they actually affect your financial world. So look forward to working with you on this. Please apply for that scholarship. And again, looking forward to working together on this. Thank you.